new product we've launched right now is a bonding insurance product which covers bid bonds, performance bonds, retention bonds. I think the approach we've taken is that the banking sector has stronger client relations with exporters, but what it has discovered is that most active exporters will be running off their limits, either in terms of country limits or their credit limits within the banking sector. So we've entered into a partnership with the banks where we share the risk on those bonds 50-50, and we do this through an umbrella agreement, which we call the risk participation agreement, which then means the exporters falling under the program are able then to have their limits increased and can turn things around quickly when looking for bonds and can compete for more projects on a simultaneous basis. So it's to increase the capacity of the exporters to raise bonds and compete for projects, which is in line with the mandate of ECIC, which is to facilitate export trade.
And how will this benefit the South African and mining industry in the longer term?
I think whilst the product itself is not restricted to the mining sector per se, but some of the role players like Avenge and Group 5, they're very active in the mining sector. And then what they should be able to do, their existing lines, they can commit, to the other sectors, whilst knowing that they can fall back, the mining divisions can fall back on this arrangement that we've got, and then compete for projects and put themselves on the line for new contracts with, sponsors.
What are some of the lessons that you've learned during the economic situation in the past year?
I guess what has come true, some of the projects we've supported have been hit by serious risks. For instance, a project in Liberia has had to contend with the Ebola risk. Over and above that, compound the matters further is the global commodity outlook has become negative and has affected them. So in that regard, working with sponsors with deep pockets is very important, because in such a climate it becomes difficult to raise additional equity, and also having standby facilities, debt facilities to deal with cost overruns and other working capital requirements becomes a critical part of debt structuring. So in future, these are areas which we think will become very important when one is structuring projects.
So this product that you launched, does this follow from the lessons learned?
No, this product is just an additional service offering we're giving, where in the past our products tend to benefit the banks more. This one is gives a more direct benefit to the exporters. I think that's what we like about it, is that exporters now will be able to access more bonds. I think us as being an export credit agency, it's always been a challenge for us to find new products that can respond more effectively to the needs of the exporters.